You know what everyone assumes the ultra-wealthy are buying? Gold, Bitcoin, real estate, stocks, the usual headlines. Financial television breathlessly tracks every uptick in precious metals, every surge in cryptocurrency, every trophy property acquisition. Gold hits $4,000 an ounce and the talking heads speculate about hedge funds piling in. Bitcoin nears $100,000 and the narrative becomes that the super rich are diversifying into crypto. Housing markets spike and we are told billionaires are scooping up mansions by the dozen. That is the mainstream story. The assets that dominate conversation, the ones analysts dissect, the ones retail investors emulate a few years late. But here's the part almost no one bothers to tell you. While the financial press is fixated on gold and Bitcoin, while retail investors chase the same assets the wealthy bought half a decade ago, the truly rich have quietly moved on. They are accumulating 3 asset classes you have probably never heard about. These assets are obscure enough that most financial advisors could not explain them, essential enough that when the system strains they will be more valuable than gold, and being bought not in press conferences but via shell companies, private deals, and legal structures explicitly designed to conceal ownership. No tweets, no CNBC segments, just cold, methodical buying. I'm going to walk you through exactly what those 3 assets are, why billionaires are piling into them right now in 2025, and most importantly, how someone who is not a billionaire can access similar exposure. This is not about imitation for its own sake. It's about discerning where real wealth concentrates when currencies crack and supply chains fail, when the financial scaffolding that held the post-war era together starts to wobble. Let's start with the first asset. It sounds dull, and that's why it's brilliant. Boring equals durable value. The first asset the ultra-wealthy are hoarding is farmland, not generic acreage. Very specific farmland in precise regions with characteristics most people miss. And the single individual who has amassed more private farmland in America than anyone else is a name you know, Bill Gates. As of 2025, he owns roughly 275,000 acres of farmland across the United States. That is not a rounding error. 275,000 acres. To visualize that scale, think roughly 430 miles of contiguous farmland, larger than the city many associate with glamour and size, and comparable in area to an entire small country. Gates has been accumulating farmland systematically since 2013 through his investment vehicle, Cascade Investment, but the strategy is surgical. He is not buying random plots. He is buying land with a repeatable pattern of attributes: extraordinary soil quality, trustworthy long-term water access, and microclimates that permit extended or multiple growing seasons. When you map his holdings, you see the logic. His largest single-state concentration is in Louisiana at roughly 9,701 acres, not scattered across the state but clustered in the Mississippi River Delta. That region offers 3 decisive advantages. First, the soil is irreplaceable. Centuries of fluvial deposition have built a topsoil layer that cannot be reproduced by fertilizer or engineering. Second, water access is abundant. River systems and deep aquifers provide reliable irrigation even when surface conditions elsewhere dry out. Third, the growing season is long. Some parcels produce 2 full crop cycles annually. This is not merely about supplying food in the short term. It is about securing capacity to produce staple calories and premium crops if climate stress reduces productive acreage elsewhere. His second major concentration is in Arkansas, roughly 47,927 acres, primarily rice and soybean country with direct navigable access to the Arkansas River and the continental infrastructure for commodity movement. Again, water, heavy crops in a place with dependable supply. The third is Nebraska, farmland positioned directly over the Ogallala Aquifer, the single greatest underground water reserve on the continent. Gates focused on parcels where the aquifer depth and recharge conditions are favorable, spots that promise irrigation security for decades. In Washington state, he controls about 16,970 acres concentrated in the Columbia River Basin, where river-fed irrigation and ready port logistics enable export of grains and fruit. Florida holdings, roughly 14,828 acres, cover citrus, vegetables, and cattle operations optimized for year-round production. Every acquisition follows the same checklist: topsoil so good it can't be manufactured, guaranteed water delivery through rivers or deep aquifers, and a climate that supports multiple harvests or high-margin specialty crops. Gates is not purchasing farmland to farm it in the present. He is buying production capacity, a reserve of the most productive land on a continent increasingly stressed by heat, drought, and disrupted supply chains. And he has not stopped. In June of 2020, his firm added 880 acres in Benton County, Washington. The purchase price reported was $131,440,000, equating in certain press accounts to around $16,000 per acre, a multiple of the national average by a wide margin. Why pay that premium? Because the parcel sat in Horse Heaven Hills came with pivot irrigation, direct aquifer taps, shipping access to Pacific ports, and crucially included mineral and water rights. That last detail is the hinge that moves us to asset number 2. The second asset class the ultra-wealthy are consolidating is not water itself, but water rights, the legal authority to extract and use water. And make no mistake, water rights may be the defining asset of the 21st century. Most people conflate land with water, but in many jurisdictions, especially in the western regions, ownership of the surface does not confer the right to the underlying or neighboring water. These rights are administratively allocated, tradable, and, crucially, finite. In Western doctrine, water is frequently governed under a principle called prior appropriation, first in time, first in right. The earliest claimants, often 19th century farmers and ranchers, retain senior priority. In times of scarcity, senior rights holders receive their full allocation, while junior holders may receive very little or nothing at all. Those rights, when detached from land, become tradable commodities. If you control senior rights in a region that is drying, you effectively control a currency that every city, developer, and irrigator needs. This isn't academic. Smart capital recognized the asymmetry decades ago and went shopping. A prominent illustration involves a Texas oil billionaire who, in the last century, began buying panhandle land not for the acreage, but for the water beneath it. He assembled extraction rights capable of yielding tens of billions of gallons per year, then monetized portions to municipalities when urban growth collided with dwindling municipal sources. The sales fetched multiples relative to traditional municipal water pricing, returns measured not in marginal cents per gallon, but in strategic control value. That fortune did not come from drilling oil, it came from recognizing that legal entitlement to water would be a price-insensitive asset when supplies tightened. Wall Street did not ignore the opportunity. Specialized investment managers began acquiring farmland primarily as a vehicle to harvest embedded senior water rights, purchasing properties with low land value but extraordinary water allocation, and then monetizing the water through leasing or transfers to thirsty urban systems. One New York firm's playbook was simple: buy acreage with senior Colorado River or tributary allocations, modernize irrigation to reduce consumptive use, then sell the surplus water or the right to municipal buyers. The land itself might be modestly priced, the attached water rights carried the premium. Private actors in California illustrate the approach at scale. Some agricultural conglomerates acquired thousands of acres in the Central Valley in the 90s, capturing allocations to state water banking systems. When regulatory shifts permitted private management of those banks, facilities that store excess water in wet years and release during droughts, control over stored water translated into pricing power. During recurring droughts, those controlling interests could sell stored allocations to other farmers or municipalities at significant markups. The money made in some cases far exceeded the profits from growing pistachios or mandarins. Religious institutions and foundations are part of the new map. In certain high-value river basins, large non-profit buyers entered auctions for farmland largely because these properties carried senior river or aquifer rights. The purchase rationale was strategic reserve. Control critical water access as a hedge for institutional operations or to generate long-term income by leasing water to urban or agricultural users. The trend is not without controversy. Proposals by investment outfits to assemble and bank private water rights on an industrial scale have provoked regulatory scrutiny and public backlash. Still, smaller, less conspicuous transactions move ahead under the radar. The thesis that water scarcity is not a cyclical issue, but a structural secular shift, has high-level backers applying vast pools of capital to obtain legal control over liquid supply. Why does this matter? Because water scarcity trajectories are strongly negative across many Western catchments. Snowpack, which historically replenished rivers and aquifers, is declining. Major rivers show long-term flow reductions. Aquifers recharge more slowly as irrigation and municipal demand accelerate. Whoever holds senior, transferable rights in the right river system will command bargaining power and pricing leverage as shortages intensify. In a world where you can live without a particular fuel or commodity, you cannot live without potable water. Now turn to the third asset class, and this one is surprisingly technical and deeply financial: catastrophe bonds, commonly called cat bonds. Most retail investors have never heard of them, yet in 2025 they are exploding as an asset class for the wealthy. Cat bonds are insurance-linked securities that allow insurers and reinsurers to transfer extreme event risk to the capital markets. The structure is elegant. An insurance company facing potential exposure from hurricanes, earthquakes, or wildfires creates a special purpose vehicle which issues bonds to investors. The invested principal is held in collateral and invested in low-risk securities. Investors receive elevated coupons, often several percentage points above comparable treasury yields, for agreeing that if a defined catastrophe occurs, the bond principal will be diverted to cover insured losses. If no trigger event occurs, investors receive their principal back plus the coupon. Why would someone take the chance of losing principal to a hurricane or huge quake? Because the yields have been extraordinary and the risk is largely uncorrelated to traditional financial risk. Catastrophe frequency is a function of geography and climate, not corporate earnings or macroeconomic cycles. In years when equities fall sharply due to policy shocks or recessions, a well-diversified portfolio of cat bonds often remains unscathed because economic downturns do not cause hurricanes or earthquakes. To quantify the attraction, consider that over recent periods cat bond returns have significantly outpaced market averages. In a recent year, the average cat bond returned double-digit percentage points while broad equity indexes posted single-digit gains. During market stress in which stocks collapsed, cat bonds in some periods actually produced positive returns. That lack of correlation is the central selling point for institutional allocators, pension funds, sovereign wealth funds, and endowments, who want uncorrelated yield streams that bolster risk-adjusted returns. The market has matured dramatically. Total outstanding issuance has ballooned into the tens of billions of dollars, and annual issuance hit record levels during the rolling period from late 2024 through mid-2025. The reasons are worth spelling out. First, climate change is increasing the frequency and severity of insured losses, pushing insurers to seek more capital backing than traditional reinsurance markets can supply. Second, insurance premiums and cat bond coupons have risen, enticing more investor capital. Third, institutional recognition of cat bonds' diversification benefits has driven allocations from pension plans and large asset managers, creating a feedback loop of demand and issuance. Importantly, the universe of covered perils has broadened beyond the traditional American hurricane market. Cat bond structures now transfer earthquake risk in high-exposure markets like Japan and California, wildfire risk across multiple continents, flood risk in Europe, and even pandemic mortality risk. Historically, reinsurers dominated issuance, but now primary insurers increasingly access capital directly via cat bonds, establishing them as core infrastructure for enterprise risk management. This is where the billionaire flow becomes visible. Hedge funds, dedicated insurance, linked securities managers, and private wealth vehicles allocate meaningful percentages of their portfolios to cat bonds or to funds that specialize in them because a disciplined, diversified cat bond portfolio can offer elevated yields with a non-correlated return profile. Pension systems and sovereign funds allocate as part of liability-driven strategies. The result is a market that is simultaneously deeper and more efficient, which attracts more capital until yields compress. Smart money positions early to capture structural excess returns before the crowd commoditizes the asset. A quick math illustration. Over long multi-decade periods, cat bonds have produced yields that, on average, exceed expected loss by several percentage points annually. That margin arises from investor risk aversion to unfamiliar perils and from market inefficiencies that skilled quantitative teams can exploit. Loss seasons will occur. A severe season can trigger multiple bond payouts and cause principal erosion. But over time, a diversified sleeve of securities has historically outperformed many traditional fixed income buckets. So why these three assets together? Farmland with guaranteed water access, water rights themselves, and catastrophe bonds share a common set of characteristics that explain why capital is rotating into them: scarcity, essentiality, inflation resilience, and disaster resistance. Scarcity: you cannot create new, deep topsoil overnight. Premium irrigable acres above major aquifers are finite. Water rights were allocated historically and cannot be conjured by balance sheet moves. Catastrophe risk is geographically fixed by climate and tectonics. These are not fungible, endlessly reproducible financial products. Essentiality, food, water, and societal resilience are foundational human needs. Even in a world flush with fiat liquidity, these three resources remain non-negotiable priorities. Ownership or control over them confers not just economic return but strategic leverage. Inflation protection. When currencies lose purchasing power, commodity and real assets appreciate. Farmland generates income tied to food prices. Water rights appreciate as scarcity intensifies. Cat bonds typically pay yields that reflect inflation dynamics and can be structured to protect purchasing power. Collectively, they preserve real value in ways paper assets sometimes cannot. Disaster resilience. Farmland can continue producing value through economic cycles. Water rights gain value when droughts tighten supply. Cat bonds literally exist to be uncorrelated with financial market collapses. Billionaires are not seeking flashy annualized returns. They are buying buffer zones for capital, assets that preserve and transfer wealth across systemic disruptions. That raises the obvious question. You are not a billionaire. How do you get access? Directly buying tens of thousands of acres, negotiating senior water rights, or placing $10 million minimums into a dedicated insurance-linked securities fund is out of reach for most. But there are accessible intermediaries and public vehicles offering scaled exposure. For farmland, certain publicly traded real estate investment trusts, REITs, specialize in agricultural land and provide dividend yields plus price exposure to farmland values. There are also fractional farmland platforms that pool retail capital to buy specific farms. Investors can often begin with five-figure sums and receive pro-rata crop revenue and land appreciation participation. These options are not identical to owning a 1,000-acre tract with senior water rights, but they offer practical entry points to agricultural returns. Water exposure is trickier because water rights are predominantly privately negotiated. However, you can gain thematic exposure through water utilities, infrastructure companies, and technology providers focused on extraction, treatment, and distribution. There are ETFs that aggregate companies across water supply chains, pump manufacturers, filtration firms, utility operators, providing a proxy for the underlying scarcity trend. None of these is a perfect substitute for senior river rights, but they participate in the economics of water scarcity. Catastrophe bonds are more accessible than many think. Mutual funds and ETFs now package diversified portfolios of insurance-linked securities and offer daily liquidity with lower entry points. These pooled vehicles absorb single bond volatility and provide retail investors a way to access the yield premium of the cat bond market without direct $5 or $10 million ticket sizes. Fees and liquidity profiles vary, so due diligence is essential, but the barrier to entry has lowered compared to a decade ago. A candid warning is necessary: these instruments are not magic. They carry their own idiosyncratic risks. Farmland values are local and can be impacted by regulatory shifts or crop failures. Water rights come embedded with legal complexity and political risk. Cat bonds can and do trigger in severe claim years, resulting in principal losses. Diversification, size-appropriate allocations, and professional management are essential. Finally, context matters. The ultra-wealthy are not merely speculating, they are positioning for a structural shift. They are not expecting overnight windfalls, they are building civilization, scale hedges. When you see methodical accumulation of boring assets by informed capital over a decade, take note. Those purchases are not fashion statements. They are longevity plays. If you take one lesson from this long view, let it be this: when money moves away from the glitzy and into the quietly essential, it is signaling a change in what will store value in the coming decades. Food production capacity, legal control over water, and instruments that transfer disaster risk are the kind of assets that matter when the financial scaffolding shifts. Whether you choose to follow those signals is your decision, but understanding the mechanics gives you an edge. You can weigh exposure, assess trade-offs, and consider how to preserve purchasing power when the conventional portfolio paradigms falter. Billionaires like the one who quietly became the nation's largest private farmland owner did not achieve that position by accident. They pursued a thesis, acted consistently for years, and focused on assets that are essential irrespective of the next market cycle. Others amassed water rights because they recognized that legal control over scarce resources translates into disproportionate bargaining power and returns. Institutional allocators shifted into catastrophe bonds when correlation breakdowns revealed the limits of traditional diversification. The pattern is clear and repeatable. Identify scarcity and essentiality, secure ownership or contractual control, and stay disciplined through volatility. These three assets, premium farmland, transferable water rights, and catastrophe bonds, are not get-rich-quick plays. They are preservation strategies for enduring wealth. They are civilization scale hedges for a world in which currencies can be debased. Supply chains can fracture, and natural events can rearrange economic landscapes overnight. If you want to follow the smart money, study these assets, understand their nuances, and pick entry points that fit your capital, timeline, and tolerance for complexity.